Moving along. In this section, we're going to talk about the different types of. We have American options and European options. Now, the difference is significant. However, it's not going to be something you need to think about or worry about because what they mean and what could happen between them and what could happen depending on which one you're using very, very rarely happens. But like we've said throughout this course, I really want to make sure that we build a foundation of options trading so that instead of just jumping to the end, we have a good foundation of everything else. American options can be exercised at any point in time up to the contract's expiration date. This is something that very rarely happens because of time decay and time value. If you purchase an option, you are paying the premium, which is going to be made up of two different parts. Exercising it is going to cause you to give up a portion of that. So there's really no reason to exercise it. However, if you are required to, based on your trading plan, or if you are a trader for some firm and they require you to, you would need to make sure that you purchase the American style options. Most stocks that we are going to be discussing, which, as we have said earlier, is going to be Apple, most indices, just about everything you purchase, just about every option that we are going to be discussing are going to be American style. Jack buys an option contract to purchase Apple shares with the current market price of $390, strike price $400, with 6 months to expiration. The price of Jack's option is favorable. He's got a gain 3.5 months in. Apple shares price increased $440. Jack can exercise the position and make a profit of $40 per contract without waiting to the maturity date. With that being said, European options on the contract expiration date, you are able to and only able to exercise your rights. So let's look at an example. Jack buys an option contract to purchase Apple shares with the current market price of $390 at a strike price of $400 with 6 months to expiration. Price of his call contract is very favorable. He's got a gain at 3.5 months in. As Apple's price increased to $440, Jack is unable to exercise that option. He's unable to go into his account and click the button exercise. Maturity, Apple share price decreases to $380 on the expiration date. Jack has the option to exercise the trade. However, if we see this example, we can see that Jack would have loved to exercise 3.5 months in, but because he was forced to wait till maturity, he took a loss. Now let's discuss this. Let's look and think about what we just did with the American style versus the European style. And it's important to understand that trading options is not something where we are going to be exercising. I have been told that being exercised, if you are in a position and the person on the other end exercises their right to pull your stock, is the equivalent to getting struck by lightning. So although we are talking about it, we are discussing it in a way that hopefully allows everyone to understand how an option works and what the math is behind the option. Talking about trading them in and out is something we will get to. With this style of option, Jack would not be able to exercise until maturity, and he would have taken a complete loss. Calls and puts. These are the two options that we are going to be discussing throughout the rest of this course. Everything we have discussed up to this point are characteristics of calls and puts. So what is a call option? A call option was defined and was named a, quote, call option because your rights are calling away the asset that someone else owns. The owner of a call option has the right to purchase the underlying asset, for example, Apple stock, up to maturity at the price, strike price they selected. Tiffany owns a call option that has a contract specified strike price of $50 up to maturity. If the stock is worth $80, she can choose to, 1, exercise her call option, buy the underlying stock at $50 for a profit, or allow the call option to expire at the share price the day of expiration. In this example, Tiffany would almost certainly refer to her trading plan and decide on whether or not the gain she has as Apple stock hits $80 a share with a $50 strike price if she should go to the market and close the position out. Or if her trading plan says that she has to make the purchase of this option and she's required to hold it until maturity, those are her two options. What is a put option? The owner of a put option has the right to sell the underlying asset, for example, Apple, up until the maturity at the strike price that they selected. Jack owns a put option that has a contract specified strike price of $50 up to maturity, even if the stock is worth $25. He can choose to exercise his put option and sell the underlying stock for a $50 profit, or allow the put option to expire the price on the day of expiration. In my opinion, stocks seem to grind higher over time. And if you are going to be a buyer of an option and you buy a call option, holding it to maturity may be a good strategy depending on what strike you pick and depending on what stock you pick. If you've traded stocks, if you've watched the markets, you will notice that it takes a very long time for stocks to move higher. And when they sell off, it tends to happen very quickly, which is why the emotional aspect of trading options is going to become even more important, as I've been saying, as we get closer to doing this in real time. When you buy a put option, you are basically saying, I think that this stock is going to go down. Now, if you look at the chart of Apple or the S&P 500 or Amazon, you will notice that the stock does go up, then it may have a little bit of a sell-off. Then it'll go up a little bit more, and it'll have a sell-off. Buying put options is a timing game. There are two things that they say when you are putting a position on that requires the underlying asset, the stock or the stock option, to go down in order for you to make money. And the two phrases are, you have to be able to time it right, or you have to be able to carry the trade. Because as time moves on, the put option that you purchase is going to continue to lose value based on time decay. And we will get to that. When you buy a call option, the longer you give yourself till maturity, the more likely it is that you will make money on that trade. However, going back to the strike price, the expiration date, and the premium paid, certain aspects of your position may not meet your trading plan. You may not have the dollar value in your account to purchase a call option that is 6 months to maturity. You may only have enough money to fund a call option that's 30 days to maturity. You may only have the ability to buy an option that is at a 9-month maturity, but it might be $100 out of the money, which would be the strike price, $100 higher than where the actual stock is trading on the day you put the trade on. Most buyers of options and most sellers of options will use call options. Put options are inherently a little bit more challenging to make money on because, again, we need to make sure that we're purchasing it in order to either hedge against a position that we have. For example, if we have a $100,000 position in Apple and we are afraid that there could be a sell-off in the future, we could purchase a put option for 90 days that will protect our total Apple portfolio in the event it goes down. So the question is, now that we have this put option we've purchased on Apple, and Apple does move down, what do we do? Most trading plans will say, we know that Apple is not going to go out of business, and we know that Apple is almost certainly going to bounce back. We don't know when, but it is almost certainly going to bounce back and grind higher in the future. So we are going to take our gains in this put option, in the option that we put into our portfolio to hedge against Apple selling off, now has paid off. We have a gain in it. We are going to go to the open market and we are going to sell that put option to someone on the other end. Thinking about the word exercise is something that, although we have been talking about it, is not something we would do in this situation. We would sell it on the open market. If we were to have sold Apple stock and we were selling it and taking a short position, in that scenario, we are selling something for, let's call it $390 a share, and we hope to purchase it back at $300 a share. Now, let's say, for example, Apple goes up from $390 a share to $440 a share. Well, just like we would make a gain if we bought Apple, now we're taking a loss because we sold it for $390 a share, and now we need to purchase it back for $440 a share. What most trading plans and what most investors will use call options for to hedge against risk of shorting a stock in a portfolio is, as Apple stock moves higher, the call option that we own will move higher as well, thus hedging against the risk of Apple stock moving higher and us having to buy it back at a loss. We are going to get into more examples and we are going to dig deeper into hedging against different positions in your portfolio. We are going to discuss in more detail what happens with a call option and the time value of it. At this point, I wanted to just give a couple of examples as to what a call option is, what a put option is, and some basic uses for the two of them. I want to thank you again. Next up, we are going to be talking about whether we would like to buy or sell an option.